Very good afternoon, good morning. Welcome to FX Week Ahead live market analysis with myself, Giles Copland, Chief Currency Analyst. Very good to have you here. Special welcome to you, especially if you're new, and also a warm welcome as usual for the regulars. Looking forward to taking us ahead this week. Interesting week, and we could see some interesting moves. So it's definitely one to get prepared for. Well ahead of the event. Just check you can see my screen and hear my voice okay. If you could just let me know in the question and chat box that you can see okay, that would be great. Any issues, please do let me know so that I can adjust that as is necessary. I'm assuming everything is okay. No news, as they say, is good news, so I hope that the screen and voice are all coming through okay. Don't forget, during the webinar, if you have any questions, feel free to ask. The whole purpose of this webinar is that I'm going to clue you into the major drivers for this week, so you can see how someone with a professional trading background goes about trading, goes about analysing, understanding markets, so you can make better trading decisions for yourself. That's the whole fundamental bias of what's happening. These are the key issues we'll be looking at. Growing inflation fears. It's all about stagflation. I'll explain what that is. And how to look for that, and I'll also explain what markets move and rise and fall in a stagflationary environment. Inflation for the UK is absolutely critical at the moment. I'll explain what's going on with the pound, why the pound has been bid recently, what's driving that. We'll also look from the Chinese GDP data that came in overnight and how that's fueling stagflation fears. We'll look at how to trade gold and silver, German PMIs, next to global stocks as energy fears rise, and we'll check out the Euro-US dollar and also oil markets. So we've got plenty to cover. So without further ado, I'm going to jump over to the main screen and we'll get stuck straight into what we're doing. Okay, so first off on the agenda is just going to remind ourselves what stagflation is. So first of all, what is a stagflationary environment? Right, bottom of the screen, inflation, top of the screen, growth to the left. Up, growth, up, inflation. At the moment, the base expectations is that the market's in a reflationary environment. High growth, high inflation. Why high growth? Stimulated by all the easy monetary policy. Low interest rates mean cheaper for companies to borrow, it means they can grow. The fiscal stimulus by governments giving job schemes, paying benefits, all that helps growth. And inflation is rising higher, so the base expectation is a reflationary environment. What's the fear? It's this, that actually reflation becomes stagflation. So stagflation is high inflation, but low growth, right? Now, which one are we in at the moment? We're hovering. Markets think, oh, we're in a reflation, but are we going to go into stagflation? And notice they're quite different, because in a stagflationary environment, we see quite different moves than we do in a reflationary environment. So notice, in a reflationary environment, very strong for commodities, copper, etc. But notice in a reflationary environment, it's not so good for base metals for copper, but it is good for gold, whereas a reflationary environment is negative for gold. So there are some very different expectations potentially brewing up. So now that we've understood that, let me show you what's happening. So last night we had more fueling of the reflationary environment. Now, the Reserve Bank of New Zealand, we had CPI data released, and the year-on-year reading was the highest in 10 years. 4.9% for the third quarter reading versus 4.1% expected. That is very fast. There is now 50-50 chance of a 50 basis rate point hike by the Reserve Bank of New Zealand. Now remember, Governor Ross has tried to dial back expectations of a 50 basis points rate hike by saying previously that normally central banks increase rates by 25 basis points. But markets are now fearing that this high surge inflation, greatest in 10 years, will mean that in the November rate meeting, the RBNZ will have to hike by 50 basis points. That has really sent a surge higher in interest rate expectations for the AUDNZD. And if you just have a look here, you can see that the New Zealand bond yield, 10-year bonds, have surged higher on those inflation expectations. Now, this means there is a medium-term upside bias for the New Zealand dollar-Japanese yen pair. This is a clear potential tradable opportunity. So if you just take a look at the New Zealand dollar-Japanese yen pair, you can see that's been moving significantly higher recently. Why? If you look at the bond yield spread between New Zealand 10-year bonds and Japanese 10-year bonds, do you see how they spiked higher up out of that key long-term weekly trend line? Notice how the New Zealand dollar-Japanese yen pair tracks the bond yield spread very closely. That's a typical relationship that you would typically expect to see. So as a consequence, 10-year yield bond yield spread between the two have just rocketed higher. Expectations are buy on dips. That means medium term, any retracements back down to that 80, 79 region can be considered suitable for going long. The Bank of Japan, unlike other world central banks, don't have expectations of raising interest rates. Now, the Bank of Japan has stagflationary environment, very low deflationary forces. They're not expected to raise interest rates at all. Whereas if you look at the bond yields across the world, they've been surging higher. You see here, US bonds, German bonds, Canadian bonds, New Zealand bonds, Aussie bonds, UK bonds have been generally moving higher, and Japanese bonds have been flat. Now, they've been flat because the Bank of Japan does something called yield curve control. So that's why the yen was incredibly weak last week. It was weak, and if you want to just follow me on Twitter, I'll do put up, decent tweets from time to time. And in one of my latest Twitter posts at the end of last week, I just explained why the Japanese yen was so weak. And you can see here, Japanese yen weak across the board. Why? For the very simple reason that inflationary fears have investors seeing the rest of the world's central banks hiking rates, but not the Bank of Japan. So my Twitter handle is here, at Giles Coughlin, at Giles Coughlin CCA. Okay, at Giles Coughlin CCA. You can follow me along there on Twitter. So those raising inflation expectations have been surging yields higher, but also we have had some very low growth out of China. So if we just take a quick look at the Chinese growth, you'll see that that has been dropping lower. Remember stagflation, slow growth, high inflation? Well, that's what markets are fearing. I'll just have a little look at that here on my news feed. Yeah, here's the GDP data. Missed expectations. Year-on-year growth came in at 4.9 minus 5.2 expected, a miss. Industrial production 3.1 versus 4.5 expected, a miss. Retail sales better than expected, 4.4% versus 3.3%. What does this show? Slowing growth. China is the world's second largest economy. If China's growth slows, the whole world's economy slows. So the markets have opened up this week on a risk-off tone. Equity markets slightly lower. Commodity markets, oil pushing higher due to key support. Copper prices broadly just higher, but quite off best levels. Gold and silver flat. Iron ore prices still pressure to the downside. Coal prices moving higher. Now, quick aside, the best area to go long on oil is from 77. That is a very key overhead resistance level here. So resistance turns support. Now, why is oil markets moving higher? For a few reasons. One, falling COVID cases around the globe, rising vaccination cases. Two, demand is expected to increase over the coming weeks and months as the world gets back to flying and moving and traveling again. Three, OPEC do a very good job at maintaining the just up the right amount of oil supply level to keep prices supported. All of this means oil remains a buy on dips. Hard to get into oil because it's just sort of pushing, higher and higher and higher. So it's a buy on dips. The very aggressive entry would be here at a 70, at an 80 region. The best entry would be any retraces back down to 77. You'd expect to find buyers at that region. Okay, so that's what we're potentially having a decent look at with oil. Moving through, we are seeing bond yields moving higher. Now, the reason bond yields are moving higher is not for a good reason, it's for inflationary fears. The yen crosses are very pressured to the upside, and look for any dips lower in the yen crosses to find buyers, particularly New Zealand dollar yen or New Zealand dollar Swiss franc. Both of those areas look pretty decent for buyers heading into the following week. Now, just taking a look at the calendar coming up, let's see some of the key events. Monetary policy meeting minutes will be very important for the Aussie dollar. The latest RBA rate meeting, do make sure you're checking out my blog here. Go to Central Bank Watch under the blog.hycmlab.com. I do keep ourselves up to date with the latest central bank meetings. And just notice that the last RBA meeting, I titled it On Track for Recovery. Yes, they had some very large short positions, but those short positions look quite stretched. So it'll be very interesting to see here what happens with the Australia dollar going forward. And notice we were looking at this sort of support region around the 80 region in the Aussie yen, and you can see that that 80 region formed that support. We've had a rip higher in the Australian dollar Japanese yen since that last RBA rate meeting. Do have a look at that and check out that for more detail. However, in terms of the fundamental calendar, we want to see any hints from the monetary policy meeting minutes that indicates the RBA may be raising interest rates sooner than 2024. At the moment, they say 2024 before they raise interest rates. What's good for China is good for the Aussie dollar. What's bad for China is bad for the Aussie dollar. Also notice that the Australian dollar is heavily driven by the following commodities: the iron ore markets and coal markets. So coal markets moving higher, which supports the Aussie dollar. Iron ore markets pretty pressed to the low side. If all of a sudden we see iron ore prices surging higher alongside coal prices and a recovery in China, that would be strong upside in Aussie dollar. So that's what we'd look for with the meeting minutes. If there was something more positive in the meeting minutes, upside in iron ore, upside in coal, upside in Chinese data, then look for Australian dollar strength. We have Fed speakers, and again, the basic story is markets are expecting the Fed to raise interest rates September next year, announce tapering in November, and the end of tapering in the middle of next year. So all Fed speakers will be scrutinized through that framework. The main event of the week is UK CPI without a shadow of a doubt. Now, I'm going to go back over to our main screen, and I'll just run through what to expect with this. Now, the UK has seen a lot of strong pricing in SONIA futures recently. I'll show you them in a minute, but in fact, let me just jump over there and show you these SONIA futures now, because it's worth seeing. Worth seeing for yourself. Right. Now, these SONIA futures show you what market participants are thinking about coming UK interest rate hikes. The way you work them is you take a SONIA future, you take, say you take the September contract, so 2022 September 99.11, the current interest rate is 0.10. So you just add that to it, 99.21, then you subtract that from 100. So that's like 0.78% interest rate hikes expected by the September of next year. And in the December contract, you've got, heading up towards 1 basis point. 100 basis points of interest rate hikes. So is the Bank of England really going to hike interest rates at that speed? It seems unlikely, doesn't it? Are they really going to hike 4 times between now and next year? So you can see how much pricing has gone into the SONIA futures. There is a distinct danger of a, sell the rumor, buy the fact approach coming to that meeting. Now, looking here, you can see the pound, and just looking at the pound over the last sort of 4 or 5 days, you can see the pound has been gaining strength, and it's been gaining strength on expectations of coming interest rate hikes. And the reason for these interest rate hikes that are expected are all to do with the fact that the UK is expected to raise interest rates to control rising inflation. So as a consequence, this is what we want to look for. So we've got retail sales coming up, but the main event is the core CPI. Now, you can see here CPI is expected to come in at 3%. Now, if it comes in above 3.3%, here's what we'd expect. So if it comes in above 3.3%, close to above max, we expect more upside in the pound yen upside, euro pound weakness. If the retail sales and PMI data surprise to the upside, reduce stagflation fears, then that's a more pound upside, euro pound downside. The best opportunity comes from dovish outcome. If the CPI is a miss, so look, we're looking for 3%. If it comes in below 2.8, that will be a miss. That's the best opportunity, because that will mean that the Bank of England have been too worried too quickly, and the pound would likely retrace some of that strength. We'd see SONIA futures retrace, and we'd see downside in the pound. So that'd be euro pound upside, pound yen downside. Best opportunity will be euro pound upside. So look for that. We've had quite a few shifts around at the moment. Here's a little chart from Vanda Research, and they show what's been happening. So rate hike at the moment, Ramsden, Saunders, Bailey's moved towards the rate hike. Cunliffe, Broadbent, Haskell, Torreira, Mann are all likely to vote against the November rate hike, and Pill is looking to go forward. So it's like 5v4 at the moment. So as a consequence, it's quite a balanced act. So there is a strong risk of some pound upside if the CPI inflation surprises to the downside. So just look at that, take a screenshot of that. That's what we're looking at for this coming week, and that's what you should be focusing on. Best opportunity of the week that's scheduled. Returning to the rest of the week, we see CPI data coming out of Canada. Again, we are expecting generally high inflation across central banks. If we see more inflation coming from the Bank of Canada, that just plays into those inflationary fears around the world. Wouldn't be surprised to see a little bit of upside in CAD, but remember, it would depend on the risk tone. It's nothing that's necessarily tradable. Thursday, Governor Lowe speaking. That's important. We want to see any hint from the Reserve Bank of Australia that they're starting to feel optimistic again will be jumped on by markets. Yes, we need to see iron ore prices rising, coal prices rising, some bullish sentiment out of China. That would be supportive for the Australian dollar, as well as a positive risk tone. But if we see Governor Lowe showing more optimism about the recovery of the Australian economy, that in itself can create bullish sentiment for the Australian dollar. So that is a speech that you want to be aware of and have reference to. Manufacturing services PMI also to be taken into account, but less impact expected than the governor's speech himself. Friday, finally, that Eurozone data of importance. Now, the general slowdown in Germany has been noted by markets. So we've seen a revised growth to the downside for German GDP last week. We also saw negative ZEW economic sentiment data out of Germany, showing still a depressed bias by German businesses. Obviously, supply chain issues, COVID-19 issues, all weighing on sentiment. So it'll be very interesting to see what happens with the PMIs this week. If they're another miss to the downside, expect that to weigh on the euro. And remember, the euro pound is going to be very interesting with the CPI data. And we also want to keep a careful eye on the euro-US dollar pair. So just have a little look here. The bias at the moment for the euro-US dollar is tilted to the downside, but if risk markets turn more reflationary, more positive, we could see some euro-US dollar upside. So the tricky thing about the dollar, remember the dollar smile theory. When investors are expecting like the rest of the world to grow quicker than the US, in a reflationary environment, you expect dollar weakness. The dollar is strong on two situations. One, if the Fed's expected to raise interest rates and a boost in US economy, that boosts the dollar. And two, the dollar is boosted on risk-off safe haven flows. So, you know, dollar unable to push above 94.50, the reflationary narrative would say the dollar's due a little bit of weakness. If the dollar does see some weakness, then you could expect that to lift the euro-US dollar higher. Okay, so keep an eye on the dollar to know what's happening with the euro-US dollar, and look out for that economic sentiment from Germany to potentially be a catalyst for fresh euro-US dollar action on the Friday. The rest of the situation for this week will revolve heavily around earnings. So we have some earnings around Tesla. We also have earnings for Netflix out this week. And what market investors will be looking at is looking at the revised growth forecasts. If they start seeing companies revising future growth forecasts downwards, that will give a very strong negative bias for risk tone if future earnings start missing and they start getting revised to the downside. So watch out for that. It can impact the overall risk tone. The big issue is going to remain this week: inflation, how high is it? And growth, is it slowing? Also notice natural gas. This is at a very key pivotal part. You can see natural gas trying to push through this trend line to the downside. If we see natural gas pushing lower, then it will not be a surprise to see that be positive for risk sentiment. You can see natural gas pushing higher into that gap, then selling off, looking to break down through that trend line. If nat gas stays below that trend line, that's positive for risk sentiment, because remember, the natural gas prices soaring higher impacted risk sentiment and concerned investors that rising energy prices was going to create an energy crunch, slowing growth rapidly and fueling uncontrollable inflation. If those nat gas prices can start dipping lower, that will reassure investors, particularly in Europe, that the energy crisis is being controlled and maintained. Obviously, check out for any data from Russia. Anything to do with gas supply will be important for those markets. Okay, folks, that is all for today. I've covered quite a lot. I hope that's helpful. I hope that clues you into the major issues. It is that UK inflation data, which gives the best opportunity for coming week. Make sure that you are clued in for that and ready. You can always go through this webinar, get the recording, but make sure you've got a screenshot of that information. In fact, I will just put this out again, and I will just look at the main screen. So if you haven't got a screenshot, make sure you grab a screenshot of that now, and so you're most prepared for the week. Are there any questions or any areas people would like help on? just pop your question in the chat box or the Q&A box. Let's have a look. Okay. Yes, Max, well said. You're right. It is a very tricky environment to trade. New Zealand dollar longs look very stretched. They do. I think the Aussie New Zealand dollar is the pair I've got a sell trade on in the Aussie New Zealand dollar. In fact, I'll just show you how I'm managing that. Right. I'll show you now. Max, thank you very much. You raised a good point, and you've given me a bit of something extra I can give to you guys. Right. So Max says very helpfully, tricky environment to trade. He's right. I'm not jumping into long-term positions at the moment because which environment is going to win out? Stagflation, reflation. Just keep on top of it. New Zealand dollar longs look very stretched. Yes, they do. And this is how I traded the Aussie New Zealand dollar this last week. So Aussie New Zealand dollar, we have a sell bias here. Look at the bond yield spread is dipping lower in the Aussie 10 years, right? So the divergence here is the RBNZ expected to hike like rates 4 times next year. RBA is not expected to hike at all. So there is a down sell bias to the Aussie New Zealand dollar. I've been selling it for a while, right? Had this recent move, Aussie dollars shorts look very stretched, so we expect a bit of retracement. Got the retracement higher, and then look, medium term, Aussie New Zealand dollar downside still in play. So I did this all live last week. You can have a look on my Twitter feed. I think I've got a lot of it on. So this isn't smokes and mirrors. Saw the trend line, just took a simple trend line break entry, and now I've added another position with this attempted break of the 200 exponential moving average. Here you have a Harami inside bar pattern, break of that to the downside. Typically, you'd expect that to result in more downside. So I'm just going with a break of that Harami inside bar, looking for further falls, just stops above that. So I've got one position running. I've added a second position, and it's all on the very high inflation data out of the New Zealand. Massive increase. Now, is New Zealand dollar stretched? Well, yes, it is. So let's look at, where are we? There we go. Let's look at some strength here. And you can see, like, since 14th of October, look, New Zealand dollar is been the strongest currency out of all the currencies, right? So it does look quite stretched. Now, what's helping, I'm hoping to help me on this second Aussie New Zealand dollar short I'm opening, is just the general negative sentiment out of China that should weigh on the Aussie dollar a little bit more than the New Zealand dollar, and that spike higher in inflationary data out of New Zealand, I'm expecting just to keep the New Zealand dollar supported in the near term. But that's just a little like that's the only trade that I'm initiating at the moment. And Max makes a very good point. It's a tricky environment to trade, so only take those good, clear opportunities when it's obvious, right? And so the other way I can manage this is if I break to that 200 exponential moving average, you see I've just got a nice place to define and limit risk. If that breaks lower, then you'd expect that to keep falling lower. So it's a reasonable place to try to add to some Aussie New Zealand dollar shorts that I've got running in profit. Yeah, Max, great comment. Thanks for contributing. Okay, folks, very good. I hope you have a very good trading week. Don't forget, be back here Wednesday. I'll be making sense of that CPI inflation data. So I'll show you what trading opportunities, if any, there are on Wednesday with the workshop. So come back and we'll unpack that. For now, yen crosses look very attractive. So any deeper dips in New Zealand dollar, Japanese yen look good for longs in the current market conditions. Obviously, if there was strong risk-off trading, that would invalidate that outlook. Take care, everyone, and enjoy the rest of your trading week. Thank you. Goodbye.